Live from New York City this morning. Good morning, good morning. Your equity market positive a 0.5%. Trying to bounce. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue, falling on hard times. Tesla and Apple facing down investor skepticism. Kevin McCarthy's bid for Speaker drowning in doubt. And economists looking to China to bail out a gloomy outlook.
We're pretty bullish on China.
When China does reopen,
the reopening in China.
Right now, with the reopening, the focus shifts back to consumers.
By the end of 2023, China's no longer going to be worrying about COVID.
We should see them come out and buy crude oil.
The reopening being as quickly as it's happening probably complicates the Fed's, job.
Yes, bad news for inflation.
Putting a little bit of a bid under oil prices, putting a little bit of a bid under, inflation globally.
There's still a lot of bad news priced into China.
But it is definitely something to watch out for.
In the U.S.
The economy is flirting with a recession.
Risk of recession is certainly something that we're very focused on.
People are underestimating China's reopening and the multiplier effect on demand.
Joining us now to discuss is PGIM's Greg Peters and Invesco's Mo Hagbin. First to you, Greg. Greg, you're expecting a major shift into bonds this year. Does China's reopening complicate that move?
I don't think it dramatically complicates the move. Clearly, it puts a little more pressure on inflation, all else equal. But I'm leaning against this whole growth narrative where China opening up is just fueling the global growth outlook. I just don't see it. I don't see the global growth on the other side that China can sell into. So on the margin, it's positive, but I'm a little circumspect around the real dramatic nature of the reopening.
Mo, are you taking the other side of that?
Happy New Year, Jonathan. Nice to have you back on the show today. I would take the other side of that. I think we have underestimated some of the benefits of that increased demand coming from China. And if you kind of look at the performance of emerging markets, even in the last couple of months, we see outperformance relative to developed markets. So in my mind, that's the market telling us that there is some optimism in terms of how the demand picture looks over the next few months, as well as into the mid-year.
So Mo, let's go through your calls. Remain overweight risk via EM and developed ex-US equities. How much of that is just a China call?
Yeah, so China and I would say Europe more broadly, right? So, we see that outperformance, and that's really a call on sentiment. So we saw sentiment improve in December, and that's when we started adding risk back to the portfolio. But we're taking that risk in international markets. We actually think this is the beginning and potentially the year for international markets in outperforming developed markets, the U.S. specifically. And that's been kind of a trade that has, been hurt over the last 10 years. So a lot of the portfolio risk is in international equities and emerging market equities, but we're also adding risky credit. So that's an important factor as well.
Greg, tell me why Mo's wrong.
Well, it definitely hinges upon a pretty rosy outlook. I still think there's a tremendous amount of uncertainty. Yes, I think global central banks are not going to be as aggressive in 2023 as they were in 2022, but there's still this tension point around growth. And I don't think we've seen the full effects yet of this tightening on the growth cycle. So to me, it's somewhat premature. I still think the U.S. wins ultimately here. I think you'll see a flood into the U.S. markets, and I think all else equal, that will drive the U.S. to outperform.
Greg, given that we haven't seen the impact yet, is it too premature to start this long duration trade? The reason I bring up that question is because we caught up with Subhadra Rajapra of SocGen just yesterday, and she said to us, and I wrote this down, for the most part, the economy is going to be relatively strong. The market being so concerned about a recession so soon in the year feels like it's overdone. Greg, is it overdone?
Well, we've been talking about a recession now for 9 months, and we haven't really seen it. So, yeah, there is that potential. But I do think the lagging effect of central bank policy has yet to really be felt here. So, yeah, a slowdown, I think, is on the horizon. Where the bond market could be wrong is if you do see growth actually reaccelerate here, not slow down as central banks take their foot off the brake and curves start to steepen out, which makes it a much better outlook for risk assets and a much worse outlook for the bond market.
The upside risk to Treasury yields, let's explore that further, Greg. So we've got the risk that growth reaccelerates as they back away from rate hikes. You've also got ECB QT on top of that. You've got Fed QT that's going to continue regardless of whether they pause on interest rates. At least that's what they're communicating. Then to the BOJ. We may well get rate hikes from the BOJ later this year. I've got no idea if that transpires, Greg, but some people think it will. What do you think all of that means ultimately for this bond market?
Well, so, as you mentioned from the onset, we are pretty constructive on the bond market. We do think, there's value in bonds. I think starting point matters a lot, Jonathan. Yield levels are much higher today than where we started this time last year. So I think that matters a lot. So a lot of bad news is in the price already. So we're pretty constructive. But if you do have a situation where curves, steepen out, normalize, and front-end rates remain where they are, that is a risk factor from a bond market perspective.
Bond yields lower yesterday, lower again today. Twos right the way through 30s on your 10-year right now, down 6 basis points to 368. On a 2-year, we're down about 3 or 4 basis points to 433. If you're looking at the equity market right now, equity futures positive by 0.4%. 24 minutes away from the opening bell. A little bit later this morning, tons of economic data. Then later this afternoon, we get the Fed minutes at 2 p.m. Eastern time. Then it's payrolls coming up on Friday as well. Mike McKee, what are you looking for from the data this morning and the Fed this afternoon?
Well, John, Greg Peters was talking about the fact that the full effects of the Fed's tightening haven't hit the economy yet, and that's going to be kind of the focus. Do we start to see a change as the tightening efforts really start to come through? And we'll look for that this morning, and in particular in the Fed minutes. How long do they think it will take before we start to see an impact on the economy? And that means, do they think they need to raise rates higher than the 5.25% terminal rate that they forecast in December at that meeting? And do they need to go 25 or 50 at the February 1st meeting? That'll kind of depend on unemployment. How high, how fast does that go? It hasn't really moved. We'll get some indication today from the JOLTS report. And then, of course, we do have the payrolls on Friday. And inflation, what still worries the Fed? Are we still seeing inflationary pressures? ISM comes out at 10. We'll see what their prices paid index shows. But here's the real issue is the JOLTS numbers. The Fed's made its case that because the job openings numbers, the white line, is so far above the blue line, the hirings, that unemployment doesn't have to rise significantly because the open jobs will absorb people who lose their jobs. But the problem with that is it doesn't change the dynamic of wages still rising. So what do the minutes say about that? We'll take a look at that. The numbers overall that are going to matter right now, employment figures we get a lot of this week. We're going to be seeing JOLTS today and ISM employment, ADP tomorrow, jobless claims, and then the December payrolls numbers. Do we see the start of an impact from Fed tightening? That's going to be key. And of course, next week, we'll all be waiting for the CPI numbers because everything is still sort of rotating around. What does the Fed think and what are they going to have to do?
The day after that, we get bank earnings from JP Morgan and others as well. Mike McKee, what a start to 2023. Mike, thank you. I want to borrow that question from Mike McKee. How long are the lags? Mo Hagbin, we've talked about that before. Let's talk about it again. Long and variable lags. How long are the lags? And for someone constructive risk, the cycle, the economy, Europe, China for that matter as well. Mo, can you tell me whether you think we've seen the impact? We're just not going to see much of an impact? How are you thinking about that?
Yeah, I would agree with Greg. I do think there is a lagged effect that we haven't necessarily seen. So it would be interesting to see Friday's job reports, non-farm payrolls, and see if there's some weakness. If you look at hiring versus quits, that's definitely something that has been impacted, and we're watching that closely. So while we still see a very significant and strong labor market, there are some signs that there could be weakness on the horizon. I would say the lag is 6 to 12 months there. But for us, in the short term, we don't necessarily see a recession in the first 2 quarters of the year. And that's really more on the tactical side, positioning for a little bit of a rebound. In terms of the downside, obviously, there's downside to that call, 5 to 10% further risk to the equity market. But we do see the upside potential being much higher than that.
Greg, I listened to the companies, the big tech companies. Let's take Salesforce this morning, announcing cuts of 10% of the staff, and we'll discuss that around the opening bell. They tell me one thing, then I look at the data, jobless claims in and around 200K, payrolls this Friday set to come in at 200,000, that's the median estimate in our survey, unemployment at 3.7%, we talked about JOLTS, comes out later this morning, we're told that indicates 1.7 job openings for every unemployed American. Greg, in the labour market, where is the weakness?
Really seen it yet. So the spots where we have seen weaknesses, as you mentioned, Jonathan, is in tech, right? So tech had this massive labor boom. It's starting to come off the boil. So where you're seeing the layoffs are decidedly around the tech sector. But where you're not seeing it, which is atypical, is in the kind of the lower wage scale, the more sensitive kind of sectors like hospitality at all. So this is a very unique cycle in terms of labor and suggests a lot more underlying strength, which actually perversely means, I think, that the Fed has more to do if they want to shake inflation out of the system.
So, Greg, give me an idea of how much more work you think this Fed has to do. We're pricing at a terminal rate of about 5%. You think it's much higher than that?
I don't think it's much higher, but I do think it's higher. I think that's the risk. And you look at what the markets are pricing, they're not only pricing in, capping out around 5, but then they're but then they have it rolling over, right? And I think that's where the mistake in the market. Like, I don't necessarily see that. So I think the risk for 2023 is that inflation is embedded in the system much more than kind of perceived and anticipated. And so that means the risk that the Fed and central banks have to do more, not less. And I don't think risk markets are set up for that necessarily.
Anil Kashkari of the Minneapolis Fed speaking just moments ago, favouring raising rates to 5.4% and then pausing. Mo, largely on the same page as what Greg Peters just said. Are you on the same page?
I am on the same page in terms of the rollover. I do think that is mispriced in the market, but terminal rate around 5%, I think that would be our view as well. So maybe another 50 basis points left on the table. In terms of just the outlook, I think a pause is more likely than a pivot, right? If the market is expecting rates to start coming down towards the back half of the year, that's really more of a recessionary call. And I think for us, again, we don't necessarily see that. There is a risk of that. But in the near term, we're a little bit more bullish than the consensus.
So, Mo, coming into 23, the script for so many people was you get a dip and then you get a rip. Are you saying it's in reverse, that this equity market rallies then struggles in the back half? How are you thinking about the sequencing of that?
Yeah, that's a great question. So we don't see the V shape, right? So this is not the beginning of a new cycle in our mind. So this could be a little bit of a retracing or a W-shaped recovery. So not the beginning of a new cycle, near-term opportunity to take risk, especially in credit where you're getting compensated for that risk. If you just look at high yield, for example, you're getting about 500 basis points over. That's pretty attractive. That's equity-like return with bond market risk, and that's very attractive. Now, that said, it's not the beginning of the new cycle in our view. So there could be a little bit more of a pullback, especially in equity markets, especially in developed or U.S. markets where valuations are a little bit higher than international and EM.
Greg, just on the sequencing, just a final word to you, please.
Yeah, so I agree with Mo largely. So I think the sequencing is government bonds first. That protects you from the risk of recession. And then the roll and carry of just the bond market broadly, which includes credit. So I don't think you're induced to go out to take a dramatic amount of risk, and that means equities and other types of assets. I think the bond market is the place to be where you can get the roll and carry in this highly uncertain time.
People lining up in fixed income to say the same thing about the bond market in 23. Greg Peters, Mo Hagman sticking with us. Equity futures right now at 0.4%. Coming up, still no speaker for this House.
We may have a battle on the floor, but the battle is for the conference and the country, and that's fine with me.
The day, is it the day I wanted to have? No.
3 strikes for Kevin McCarthy. Is he out? That conversation up next.
We've attempted to bring bills on this floor to address inflation, but those bills were rejected. We can't start fixing those problems until we elect Kevin McCarthy as our next speaker.
For unity in Congress and progress in our country, Democrats are united behind Hakeem Jeffries.
Maybe Jim Jordan would be the right person because he wouldn't fight us when we try to put a balanced budget on the floor.
No persons having received a majority of the whole number of votes cast by surname, a speaker has not been elected.
Republican leader Kevin McCarthy coming up short in his bid for Speaker, failing to gather enough support from within his own party despite 3 rounds of voting.
Is it the day I wanted to have? No. But if we're able to work out our differences and take this time, we'll only be stronger to be able to accomplish the things we want.
The House returning at noon Eastern with another round of voting on the agenda down in Washington, Bloomberg's AMH. Anne-Marie, let's go straight to that quote, that statement from the former President Donald Trump calling on Republicans to vote for McCarthy, saying the following: "It's now time for all of our Republican House members to vote for Kevin. Do not turn a great triumph into a giant and embarrassing defeat." Does that statement make a difference?
Well, it remains to be seen, and just yet, Jonathan, so far you don't have any individuals of those groups of 20 that came out at the third tallying vote yesterday for the speakership come out and say that that has moved them in terms of backing Kevin McCarthy. So unsure yet if the former president's words will make any difference. When you think about some of the staunchest holdouts, like Representative Matt Gaetz, who you played a clip there, he was an individual that came to the floor and said that he wanted Jim Jordan to be Speaker of the House and wanted him to be elected Speaker. He is one individual that has said that Trump hasn't always gotten it right when it comes to personnel and leadership personnel. So there's still going to be these individuals that are going to hold out. And the issue Kevin McCarthy has is just the numbers. There wasn't a red wave. Republicans have a very slim majority. And if every member is present, he needs 218. He lost 20 individuals yesterday. So he needs to get 16 people to join him. He sent out his top backers yesterday, trying to see if they can coalesce enough individuals to back him. But at this moment, it remains to be seen if he is able to do that. Today is all going to be about, if he's not able to win the speakership, one, it'll be about did he make progress in bringing more people on board, and two, if not Kevin, then who? Well, let's talk about the who and the what next. Anne-Marie, this is great theatre for some people at least. Is it consequential? It's great theater, certainly, for the Democrats, right? They remained able to hold their line yesterday, and it just looks like the Republicans are unable to govern. At the same time, you also have today, Jonathan, in the noon hour as well, as the House members are once again trying to elect a speaker, you're going to have President Biden in a very big showing of bipartisanship with Senate Minority Leader Republican Mitch McConnell talking about infrastructure spending and bipartisanship and how that is the way to govern. When it comes to beyond the theater, does this matter? Well, it does if you think about the fact that if they are unable to elect a speaker, what is going to happen on September 30th when the U.S. government runs out of money and at the end of the fiscal year and they have to then fund the government again? Or what's going to happen when they have to raise the debt ceiling? These issues are going to become so much harder to legislate. AMH down in Washington, much more from Anne-Marie throughout the day on Bloomberg TV and on radio. Final thought from Greg Peters and Mo Hagbin back with us now. Greg, is it too early to talk about some of the consequences of what's taking place down in Washington?
Yeah, it's too early, I think. But ultimately, what I think it strongly suggests is that there's not a lot of kind of legislation that's going to get done down in D.C. Over the next 2 years. And if anything, I think it does tip the balance towards the Democrats versus the Republicans. But, more volatility out of D.C., I think that's something that we've been quite accustomed to, and I don't see that changing, unfortunately. So we've got gridlock in Washington. A Fed, some officials talking about taking rates to 5.4%, then not cutting but pausing. Mo Hagbin, what is different about this market regime that we're in right now and we're going to work through for the year ahead? And what's different about it compared to, say, what we experienced pre-pandemic?
Yeah, look, I think the political gridlock hasn't necessarily been, historically at least, an issue for markets. It's somewhat theater, as you mentioned, and gridlock tends to actually be good because when you get away from a lot of legislation and a lot of changes, that's usually uncertainty for the markets, and markets will price that uncertainty, and that's downside. In terms of what's different for this market versus pre-pandemic, I mean, I think while we do see inflation coming down significantly, and if you just look at, for example, the month-over-month inflation, you kind of see inflation coming back down into the territory where the Fed is comfortable, so that 2 to 3%. My view is that it's probably going to be elevated still, right? So structural inflation may be above 2%. And the question is, if we have a 2 handle on it, is the Fed comfortable, or is it really 2%? And I think that's going to be important to see, because the Fed has said they are not going to stop until they hit their inflation targets. But what if inflation isn't 2%, it's closer to 3%? That will be interesting to see.
Greg, how are you thinking about that issue?
Oh, I think the world has completely changed post-pandemic. I mean, the most simple way to look at it is through QE to QT. I think the world of negative rates is long behind us. I think that's a dramatic shift. So I think the world is dramatically different today than where we started in 2020. And I think that matters a lot from an investment standpoint. And so what I think that ultimately means is that investors aren't induced to take the same type of risk that they were prior to. With yields where they are, I don't think investors have to go out the risk curve, out the portfolio channel, to use the Fed's words. So to me, I think it's a very different backdrop, and I think portfolios need to shift as a consequence. And I think that means not going out to take risk in the same form as before.
Hey, Greg, great to catch up as always. Greg Peters alongside Mo Hagman. To the two of you, thank you. We heard from Neil Kashkari, the Minneapolis Fed president, just about 20 minutes or so ago. He favours raising interest rates to 5.4% and then pausing. He says the Fed must learn the lessons of the 1970s and avoid what he calls premature interest rate cuts. And that's the division between this market, pricing interest rate cuts, and these Fed officials trying to signal they're going to do anything but in 23. And as we've said repeatedly on this programme, someone's going to be very wrong at some point later this year. Coming up in the morning calls and later, Bank of America turning constructive on equities, Savita Subramaniam and why things are so bearish it might be bullish. Their conversation around the opening bell. About 5 minutes away from the opening bell, equities with a lift, trying to bounce here, up 0.5% on the S&P, on the Nasdaq, up 0.6%. That's the price action. Here's 3 morning calls for you. First up, Bank of America upgrading Merck to buy, highlighting the company's consistent revenue growth. That stock up 1%. Wolf Research downgrading Morgan Stanley to underperform from outperform, cutting shares by 2 notches, given its rich valuation and challenging macro environment. And your final call from Wedbush, cutting its Apple price target to 175. Dan Ives growing increasingly concerned about the uncertain environment and demand headwinds. That stock trying to bounce as well, up 0.9%. Up next, more on Apple and Tesla with New Street's Pierre Ferro. Plus, sentiment getting so bad that it's almost good. Bank of America's Savita Subramaniam coming up next. Your opening bell just around the corner. From New York City this morning. Good morning. About 22 seconds away from the opening bell. Equity futures up 0.6% on the S&P, on the Nasdaq up 0.8%. The small caps, the Russell, up by around about 0.8% as well. The opening bell in New York City rings. There we go. Switch at the board and get to the bond market. Yields look like this on a 10-year. Your 10-year lower by 6 basis points. The yield 367.90. Last year, this time last year, 164.73. That's the move over the last 12 months. A monster move. In the FX market, euro dollar 106.13, positive 0.6%. One to watch here. German inflation yesterday softer than expected. Disinflation in France this morning. Is that going to be the trend? Can the ECB back away? Perhaps not yet. In the commodity market, crude 74.63. We're negative there by about 3%. The oil majors, some of the energy companies had a tough ride of it just yesterday, so we'll look at that around the opening bell as well. Into the open we go. About 30 seconds into the session, we're positive by 0.5% on the S&P. On the Nasdaq, up by 0.75%. The stock to watch at the open, Tesla, coming off its biggest day of declines in more than 2 years. Abby has the story. Hey, Abby.
Hey, John. Well, this one is really pretty incredible because, of course, yesterday down more than 12%, the worst day since September of 2020, after falling 65%, the worst year ever since going public last year. So the wild ride continues. That's true, too, in the pre-market at one point up more than 2%, then down right now up about 0.5%. And it has everything to do, of course, with that pre-announcement, that typical pre-announcement that they do relative to deliveries. While it was a record, it was not quite what the street was looking for. So relative to the S&P's performance yesterday, Tesla was the biggest, second biggest point drag right after Apple. Now, relative to the deliveries, it's really interesting because, of course, there were record deliveries, right about 400,000, but shy of that 420 estimate, and also missing the estimate for a third quarter. The bigger story could be growth stalling, but you still have analysts very positive. We have 56% of the analysts on the street having a buy recommendation, 11% a sell. That could have something to do with valuation. Now, I know everybody says that the stock is overvalued, but when you look at revenues for this current year at 34% growth expected, profit around 30%, the PE, the forward PE, is 21 times. So you could make the case that it is a GARP story. They still own 85% of the luxury car market, 60%, 65% of the overall EV market. Here is the growth, though. Here is the story. And here's the big question, John, because the first quarter of this year, you can see, or last year, I should say, growth was close to 70%, and that's where it had been. And then in the second quarter, slowing to about 30%, 42%, 31%. Now, of course, that slowdown does seem to coincide with Elon Musk moving toward Twitter. The question is this big slowdown, is it macro or is it some loss of focus on the part of Elon Musk? I would argue it's too early to know, but it is a question to ask. And perhaps CEO Elon Musk is going to be putting more focus on Tesla. Of course, he is telling the employees of the company that these market gyrations don't pay attention to them. Long term, the fundamentals are strong.
Abby, thank you. That stock right now, 108.50, trying to bounce by 1/3%. Another stock to watch is Salesforce, announcing plans to cut 10% of its staff. That's almost 8,000 jobs. How many times are you going to see a quote like this from a CEO of a tech firm this year? As our revenue accelerated through the pandemic, we hired too many people, leading into this economic downturn we're now facing, and I take responsibility for that. Katie Lyons has more. Hey, Kaylee.
Hey, John, what does Tom always say? Companies adjust, and that seems to be what Salesforce is doing here. Investors seem to like the move this morning. The stock is up more than 3% in the first few minutes of trading. As you said, 10% of the workforce, those laid off employees will be provided with a minimum salary of at least 5 months worth of pay and severance, health insurance, and other resources. So that altogether is going to result in charges of up to $1.4 billion. Plus, in addition, Salesforce is going to make select real estate exits and office space reductions in certain markets, which could add another $650 million in exit charges. So all said here, we're talking charges of up to $2.1 billion for this restructuring in the next couple of years. Now, why is Salesforce doing this? You heard it from Benioff himself. They just overhired. It has almost tripled its workforce in the past 5 years. In large part, that was through a number of acquisitions, but it also picked up the pace of hiring during the pandemic boom, and now he realizes that was too much. He's noting that customers are taking a more measured approach to purchasing decisions. In other words, demand is slowing down, hence why the company is projecting the slowest revenue growth for the current quarter since going public back in 2004. And at the same time, they're facing that pressure on the top line. They're also facing pressure from investors, including activist Starboard Value, to improve their margins and focus more on profit. Basically, in a world of higher rates, it is no longer enough to talk about profit way out in the future. They want to see it now. And to Salesforce's credit, we're looking here at revenue and net income, revenue in blue, net income in orange. They are estimated to add over $1 billion in net income on just about a $160 million sales increase. So trimming more fat, trying to take more home, and job cuts are part of that, John.
Hey, Kaylee, how much more of that are we going to see in the year ahead? We've seen a lot of it already to close out 22, to start 23. Starting to see more of the same. Katie Lyons, thank you. We are about 5 minutes into the session, up 0.4% on the S&P and the Nasdaq, up 1/3%. We caught up with Mike Wilson of Morgan Stanley earlier this morning, still looking for a potential 20% downside on the S&P 500.
We think 3,000 is a very achievable number. Given our confidence on our earnings forecast. Our bear case is actually we avoid a recession, but not the slowdown. That would be the 3,000 scenario and $180 in earnings.
Bank of America's Savita Subramaniam seeing reasons to be optimistic, writing the following. One reason we are more constructive on equities in 23 is the big drop in sentiment during 22. It has been a bullish signal when Wall Street strategists were extremely bearish and vice versa. Savita, I'm pleased to say, joins us right now. Savita, wonderful to catch up with you, and a happy new year to you and the whole of the team over at BofA. Let's start there. Are things that bearish it's bullish in January?
Happy New Year. Yes, I think, what's nice to see is that there's a lot of bad news out there, but everybody is talking about it now. And what we found is we have an indicator called the sell-side indicator, and it's been one of the most reliable market timing barometers in terms of forecasting returns over a 12-month period. All we do for this indicator is we take the average recommended allocation of sell-side strategists, so myself, Mike Wilson, my counterparts, and we calculate that number over time. And what we found is that when strategists are recommending a big overweight in equities, that's precisely the time you want to sell. And when they're starting to drop that allocation and up allocations towards cash and bonds, that's precisely when you want to buy. Where are we today? We're at a 53% average recommended allocation to stocks. This is the lowest we've seen in almost a decade, and it's close to where we were in 2013, which was, again, another very prescient moment in time where this indicator told us, okay, everybody in the world hates equities. Strategists have thrown in the towel on stocks. We're in a recession. Europe's in a recession. We ran out of money in QE. That was back in 2013, and lo and behold, it was one of the best times to enter the equity market over the last 10 years. So I think, our view is, okay, it's going to be difficult. It's not going to be as easy as just buying the index and clocking in fantastic returns every year. But we do think that the good news is that folks are talking about all of the bad news. So in a nutshell, sentiment is increasingly negative. It's dropped significantly from where we were at the beginning of 2022. Interestingly, at the beginning of 2022, strategists had upped their allocations to a 60% weight in equities and a pretty low weight in cash and bonds. And, we all know what happened to equities versus cash over the next 12 months. So I think that this is a moment where we've seen a lot of that bullishness wash out of the market. Now, I'll give you one statistic. So if you look at where the indicator is today, at how bearish Wall Street strategists are today, historically, when we've been at these levels of bearishness or lower, the market has been up 95% of the time over the next 12 months. That's a pretty good hit rate. So, I think that there might be a little bit more upside risk over the next 12 months than downside risk at this point.
Just to build on something, Savita, just quickly, I've had this question already this morning. So the rhetoric is bearish. Does the positioning line up with that?
So it's interesting because positioning in stocks has dropped a bit this year from last year, but a lot of that was just driven by performance. So if you look at allocations at the beginning of 2022 and at the end, most of that drop in allocations was just the fact that equities underperformed cash. I think that where we are today is an environment where what's risky is that investors are still hugging a lot of those secular growth, long duration areas of the market. They haven't really shaken this love affair with technology and TMT, and I see that as the risk within the equity market. That area of the market is still relatively crowded. Surprisingly, energy, even though it's had, a stellar couple of years of performance, is still a pretty significant underweight in the average mutual fund. So I still think there's a lot of alpha to be made in sectors, but we have seen allocations in overall equities come down. The problem for me, though, is that everybody's talking about this recession. We've got the most telegraphed recession in the history of mankind coming up, and the problem is everybody is kind of using muscle memory to go back into what they think of as the safest equity market, which is the S&P 500. Trouble is, if everybody is in the S&P 500 and they're all selling at the same time, the S&P isn't really that safe. So our view is that within the equity portfolio, the S&P 500 is actually the most crowded ticker in the world, and it's time to go into other benchmarks like small caps. And we've talked on your show quite a bit about small caps, my colleague Jill Hall and I. And, I think that's really an area where you can get exposure to equities without the risk of, everybody being crowded into the same index fund.
So, Savita, that's the index story. Let's work through that a little bit further. Clearly, you think there's an opportunity here. It's not at the index level for the S&P 500. It might be in the Russell. Can you just go through sectors for me? with a little bit more detail, Savita. How would you express this through sectors right now, this month?
Absolutely. So I think, we're still underweight tech. We're still underweight communication services. I think those are still areas of the market that look crowded, relatively expensive. I know on some metrics, communication services looks cheap. TMT looks cheap. But the problem is TMT is a big value trap. The reason it looks cheap is that prices have fallen faster than analysts have cut earnings expectations. When we look at tech and TMT, we think earnings are likely to come down another 15% from where consensus is right now. So those are not sectors that I would be jumping into. I think where the action is going to be is the inflation plays. I mean, I still think we're in an environment where inflation might be stickier and higher than folks are expecting. Sure, it's coming down a bit, but 7% is still a lot higher than 3%. So we like energy, we like financials. I think another area that might be interesting over the next couple of years is industrials, select industrials that benefit from traditional kind of picks and shovels types of CapEx, because what we're also seeing is this massive reshoring boom where companies, mostly tech companies and multinationals, are bringing plant, property, and people back to the U.S. And that is good for automation plays, it's good for industrials, and it's also good for U.S. domestic focused companies. So I think, even there, the small cap benchmark looks a lot more domestic and safe rather than other areas of the spectrum.
Savita, I just want to squeeze this in if I can and just build on that. There's something you said in your research recently, and it was a risk factor. It was the less smooth earning streams that you can expect from diversified multinationals. Is that part of that theme?
Absolutely. Thank you for bringing that up. I think that's a really important point. So multinationals look great because they've got this global diversification. Their earnings are super smooth. They've had the benefits of globalization, this secular theme for the last 20 years. Now, all of a sudden, wham, they're hit by, supply chain issues. They're hit by, moving to net zero and moving stuff closer to their end user. These are companies that are in the process of rejiggering their entire structure, and I think their earnings are going to be much more volatile than some of the more domestic plays.
Savita, wonderful as always. Great to catch up. Really nuanced stuff, I have to say, from the team at Bank of America. Savita Subramaniam there on a more constructive view beneath the index, away from the S&P 500. Coming up on this programme, challenges mounting for big tech.
We forget how cyclical some of these tech stocks are, and I think that's what you're seeing with Apple and sort of Tesla right now as these sort of recession concerns mount.
Once Tesla's biggest bull cutting his price target just moments ago. That conversation up next with Pierre Ferro of New Street Research.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Ellen Zentner, Morgan Stanley chief economist. That conversation at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
Global equities can't do well this year unless tech does less badly. Earnings will be under pressure. We forget how cyclical some of these tech stocks are, and I think that's what you're seeing with Apple and sort of Tesla right now as these sort of recession concerns mount. But also, remember, valuations have been absolutely crushed. And if bond yields stay well controlled here and with valuations having turned around, I think that's where you're going to get some tech relief this year.
The tech sector already running into trouble this year, with two giants warning of slowing demand. Tesla dropping the most since 2020 after its latest deliveries miss, and Apple's market value falling below $2 trillion after telling its suppliers reportedly to make fewer components. With us, Kevin Tynan and Kelly Lyons for more. Kevin, can you tell me what is the big move, the big driver behind this move lower in Tesla?
Well, I think, look, this is the first time that as an automaker, this is a company facing macroeconomic pressure, which they've never done before, right? When you look at legacy automakers and the cyclicality of the industry have been through these good times, bad times, dozens of times over. When you look at the auto tech companies, the Teslas, Rivians, Lucids, even Tesla going back to 2010, 2013, when they started mass producing Model S, have never seen this kind of demand environment. It's always been easy money, stock going up, able to raise capital. sell all you build. And this is the first time that they're in this kind of economic challenge.
Katie, is that catching up with Apple as well?
Yeah, on both the supply and demand side is really the problem for Apple here, John. A year ago yesterday, this was briefly a $3 trillion company. Now it's less than a $2 trillion company, even if it's rebounding by about 1% today. And of course, this was a stock that had been more insulated from the pain that hit big tech this year. It was only down 30% in the last 12 months relative to steeper declines for the broader NASDAQ 100. But now, on top of the existing supply concerns around the COVID-0 policy in China, which has led a number of analysts to take down their estimates of how many iPhones the company ultimately is going to sell in the holiday period that just ended. Those expected to be down about 3%. Now it is also about demand concerns, with the reports this week that they're asking suppliers to reduce making some of those components for devices because of weakening demand. And of course, John, as you mentioned earlier, that's why Dan Ives over at Wedbush cut his target on the stock today.
Difficult end of 22 for these names. Difficult start to 23 as well. Kevin, Katie, thank you. New Street Research calling Tesla one of its top picks for the year, despite cutting its price target of $320 from $450. Pierre Ferro writing a recession could slow Tesla in 23, but the company is by far the best positioned to fly through tough times, growing profitably. Recent concerns are overblown. Pierre, I'm pleased to say, joins us right now. Pierre, thanks for your patience, sir. Let's get straight to it. Easy to trash a stock that's down more than 60% since the start of Q4. You tell me why the bears are wrong.
Yes, absolutely. Let me tell you what the bears are looking at. They're looking at what's happening at Twitter, what's happening with Elon Musk. It's a source of concern. It's very legitimate. Now, what they're overlooking is that the Twitter thing is a very small moving part financially. And then Elon Musk has already been in the past very hands-off with Tesla. Tesla is now a very, very well-oiled machine. Tesla still needs him as a CEO to make the calls, to make the decision, to arbitrate. But his direct daily involvement in the company is not necessary. We've seen that already in the past. And the second thing the bears are looking at, I think, with the wrong angle, is like the very steep demand slowdown we've seen in the last few weeks. So let me be clear. This demand slowdown is happening. Tesla has lower prices in China. Tesla has massively discounted cars in December in the US market. And Tesla came out with like a doubling of cars in transit at the end of the quarter. So very clearly, demand has gone through like a steep deceleration in recent weeks. Now, what the bears are missing is that we're talking about growing volume 30% or 35% instead of 45%. We are still talking about a company that has a run rate delivery on an annualized basis of 1.6 million cars today. A year, 400,000 a quarter, whereas the company delivered in 2021 less than 1 million units. So we still have a very strong growth trajectory for Tesla. And that's this like delicate angle the bears are missing. What's going to happen next year, John? We're going to see Tesla going through a recession. That's very clear. Now, let's see at what next, this year, of course. What is this year going to look like? What would this year be looking like if we had no recession? Tesla would lower their average selling price by about 10% and increase their addressable market by 50%. The car industry is extremely elastic. And so Tesla would be growing volumes by 50%, filling in 2 new fabs in Austin and in Berlin, generating significant margin expansion. Okay, in a recession, what's happening? Let's say auto demand is down 15%. That's a fairly bearish view, especially for higher-end autos. Then instead of doing that, Tesla would still take their prices down by about 10% and will grow volume 35% instead of 50%, because 15% of the demand is going to go away in a recessionary environment. So we think Tesla still grows very well through the recession, number one. And number two, taking ASPs down from here for Tesla, we think happen without a significant impact, negative impact on gross margins, because Tesla is ramping 2 new fabs. As the fabs ramp, the fixed costs are being absorbed. It's a tailwind to margins. Tesla benefits from massive subsidies in the US. And last but not least, something that most people looking at it overlook, as Tesla is ramping Berlin, Tesla stops shipping cars from Shanghai to Europe. And that's a very significant cost saving. And then last but not least, of course, Tesla is ramping the most efficient car manufacturing facilities in the world and is still lowering its overall cost base. So what the street is missing is this idea that through a recession, Tesla is going to grow slower, and it's still going to be able to do that at the premium margins they're experiencing today.
So, Pierre, this is pretty constructive stuff, including the maintenance of margins, even with price cuts. But let's go with that. Pierre, can you tell me what kind of margin, what kind of multiple, rather, that story deserves? Because I think that's what people are struggling with at the same time. With the Federal Reserve speaking just 50 minutes ago, talking about one official talking about taking rates to 5% plus and keeping them there. What's the appropriate multiple you put on that story?
Yeah, it's a very good question, and it's actually the reason why we adjusted our price target today. So when you look at Tesla, you need to think about long duration high growth. So when the stock is fully valued, the multiple recognizes that Tesla is going to grow at a very high pace for multiple years. That kind of stocks, let's talk like the one that comes to mind, of course, is Amazon, have derated very significantly in the last 15 months. And that's like the result of interest rates going up. When interest rates going up, of course, the value of time is changing, and valuations that depend a lot on long-term growth are getting cheaper. So I think stocks like that today could trade, in the 40 to 60 times earnings range when fully valued, whereas they were trading a year ago in the 50 to 100 range. So you've had a significant derating, but we are still talking 40 to 60 times earnings, because these are still businesses that can grow, volumes 40 to 50% a year, revenues 30 to 40% a year, and earnings very close to revenues because they have defensible margins. So the price target we set today is basically like 40 times the earnings we expect for 2024. Yeah. And that gets us above $300. So that means we see the stock almost tripling as you get back to a 40 times earning multiple. That sounds, for a very high growth stock, like very reasonable compared to what we've experienced in recent years, of course. But we think that's the right way to think about it, because we are in a high interest rate.
I'm up against the clock, but I appreciate the constructive view. But there's a ton of bearishness out there. That right there is one of the buys from Pierre Ferro of New Street. Pierre, we'll catch up soon. 25 buys on that stock. That was one of them. Holds 14, sells 5. A very contentious story over at Tesla. The more constructive view from Pierre Ferro. From New York City this morning, good morning to you all. About 26 minutes into the session. Equities are up by about 0.5%. This was the countdown to the open. This is Bloomberg TV.